Let's get straight to the point. The global financial order as you have known it for decades is coming apart at the seams, and I'm going to break down exactly how it's happening. 3 days ago, on May 6th, 2026, NPR published a deep dive explaining the origins of the petrodollar regime and outlining the devastating economic blowback the United States would face if it lost it. Trust me, the timing of that broadcast was no coincidence. That very same week, Iran's newly minted Persian Gulf Strait Authority initiated a massive geopolitical shift by collecting transit tolls from commercial ships moving through the Strait of Hormuz. And they weren't taking American greenbacks. They were explicitly demanding Chinese yuan. This sudden, aggressive financial maneuver arrived just 2 weeks after a highly revealing phone call between Saudi Crown Prince Mohammed bin Salman and Canadian Prime Minister Mark Carney. The readouts showed these two leaders weren't exchanging pleasantries. They were actively strategizing on how to drastically deepen a bilateral partnership spanning energy, critical minerals, defense, and aerospace. If you think this is just some fringe geopolitical theory, consider what Deutsche Bank was doing that exact same week. They were quietly distributing a stark note to their top clients, warning that the current Iran conflict will likely go down in history as the ultimate catalyst that broke the petrodollar's back and ushered in the era of the petro-yuan. We are talking about a direct warning from one of the most powerful financial institutions on earth, not a speculative white paper from a think tank, and not a dramatic newsletter. When Deutsche Bank tells clients in May 2026 that the very system that has wired our global economy for 52 years is at its absolute most vulnerable point since Henry Kissinger hammered it out with Saudi officials in 1974, you need to pay attention. Now, let me be clear. The petrodollar did not suddenly drop dead this week. Massive systemic architectures do not die cleanly on a specific calendar date where everyone can watch. But the events of the past few weeks constitute a far more lethal structural development than the scattered sensationalized headlines have managed to convey. I'm not just talking about the isolated chaos of tariff rulings, the catastrophic collapse of Spirit Airlines, or even those transit tolls being paid in yuan, even though every single one of those stories is verified, real, and highly impactful. What I am pointing to is the undeniable structural convergence of these events. For 52 years, the world organized its massive energy trade strictly around the American dollar, but right now, these nations are physically constructing the architecture for an alternative. This isn't happening in academic journals. It is happening in high-stakes phone calls between crown princes and prime ministers, in memorandums signed at massive mineral summits in Riyadh, and in hard infrastructure decisions routing pipelines west to Asian buyers instead of south to U.S. refineries. The most staggering part of this unraveling is that the very country that birthed the petrodollar simply let its 50-year foundational agreement expire entirely unnoticed back in June of 2024. 2 years ago, there were no dramatic press conferences, no formal announcements, and virtually no media coverage. It was a monumental shift that went ignored until the Iran war forcefully dragged it into the daylight. Warren Buffett has a brilliant rule for this. He argues that in business, the absolute most expensive systemic transitions are the ones that have been quietly churning away behind the scenes for years before a single visible trigger finally exposes them. The moment everyone finally notices, the shift is never the moment the transition actually began. It's merely the tipping point where the structural weight becomes so heavy that financial analysts can no longer brush it off as a minor issue at the fringes. Buffett's exact framing applies flawlessly to the petrodollar right now. This erosion did not start with the bombs dropping in Iran. It didn't start when Mark Carney picked up the phone to call MBS. The real structural crack formed the second China officially displaced the United States to become Saudi Arabia's absolute largest oil buyer. The pure economic gravity of the Riyadh-Beijing pipeline began demanding a different currency reality than the rigid security pact Washington had enforced for 50 years. The war in Iran didn't create the fracture. It just made it mathematically impossible to ignore. You have to look at the scoreboard and see the momentum. Right now, an Iranian authority is literally taxing the Strait of Hormuz in yuan. Saudi Arabia deliberately let its 50-year dollar loyalty oath die unrenewed in June 2024. The Canadian government locked down a massive critical mineral and investment memorandum with the Saudi Minister of Industry on January 13, 2026. Following that, Saudi Investment Minister Khalid al-Falih spent back-to-back days in Ottawa and on Bay Street mapping out an aggressive capital framework with Canadian ministers and market makers. By the time Carney and MBS wrapped up their April 29th call, the Prime Minister's office was openly flaunting their plans to integrate their energy, agri-food, defense, and tech sectors. To truly understand how this burgeoning Canada-Saudi empire directly threatens the dollar's automated dominance over global energy, you have to realize exactly what the petrodollar was, how it bled out, and what these nations are rapidly building over its grave. Let me walk you through the history. Because the daily news cycle is designed to make you miss the big picture. The petrodollar was never a formal, ratified treaty. There is no official piece of paper sitting in a vault. The Atlantic Council itself has explicitly confirmed that absolutely no official agreement exists mandating the Saudis to sell oil exclusively in US dollars. What we actually had was a brilliant, brutal handshake deal engineered by Secretary of State Henry Kissinger and Treasury Secretary Bill Simon in 1974. Following the chaos of the Yom Kippur War and the oil embargo, they sat down with the Saudi royal family and hammered out an understanding. Riyadh would price all its oil in dollars and park its massive surplus cash in U.S. Treasury bonds. In return, Washington would act as their ultimate bodyguard, providing advanced weaponry, economic backing, and absolute military protection over the Persian Gulf shipping lanes. Neither side ever formally codified it, yet that phantom agreement effectively became the operating system for the global economy for a half-century. The logic was flawless. When the planet's most critical commodity is exclusively bought in dollars, and the sellers recycle those billions back into American debt, the US dollar achieves a level of structural invincibility that no rival currency could ever dream of matching. As Deutsche Bank pointed out in their March 2026 note, the entire world essentially saves in dollars simply because they are forced to buy their oil in dollars. Yet, Saudi Arabia quietly let this monumental arrangement bleed out in June 2024. They made no grand declarations that would have crashed markets or sparked diplomatic wars. The 50-year Kissinger Pact simply hit the end of its timeline and was unceremoniously abandoned. Michael Harris, an analyst at EBC Financial Group, noted that this quiet death was driven by basic, unavoidable economic math. China had officially conquered the top spot as Saudi Arabia's premium customer. While legacy contracts still pointed to the dollar, the overwhelming economic momentum was pulling violently toward the yuan. Today, Saudi Arabia pumps 4 times the volume of crude to Beijing than it ships to American shores. The nation that pledged its currency loyalty to America in 1974 because of trade dominance now looks at a landscape where its main buyer uses the yuan and views dollar-denominated trade as a massive geopolitical liability. The numbers tell the true story. The US dollar's absolute share of global foreign exchange reserves has steadily plummeted from 71% in 1999 down to roughly 57% today. While Harris notes the Saudis are still conducting heavy business in dollars, the exit door has been permanently unlocked. Then the Iran war kicked that door wide open. On February 28, 2026, the US and Israel launched a massive offensive against Iranian nuclear and military targets. By March 4th, Iran retaliated by effectively slamming the Strait of Hormuz shut, instantly choking off 20% of the global oil supply. The market response was swift and brutal, with Brent crude rocketing past $120 a barrel in days, while Qatar was forced to declare force majeure on all LNG shipments. Between Saudi Arabia, Iraq, Kuwait, and the UAE, aggregate oil production tanked by 6.7 million barrels a day by March 10th, hitting a catastrophic 10 million barrel deficit just 2 days later. This is the exact raw energy shock that executed Spirit Airlines, pushed jet fuel to a suffocating $4.26 a gallon, and is single-handedly keeping crude stubbornly above $100 a barrel as of today, May 9th. But the supply disruption, as horrific as it is, isn't even the main event for the financial sector. The true paradigm shift is how Iran chose to manage the strait. They are selectively allowing vessels to pass, but strictly on the condition that the crude is purchased using Chinese yuan. This isn't a rumor. It's been corroborated by Lloyd's List intelligence, broadcasted by CNN, and categorized by Deutsche Bank as the dawn of a massive new yuan-based business arena. The most critical 20% of the world's oil transit route is now a live fire testing facility for executing at convenience. That is the exact moment the other party stops treating their exit strategy as a theoretical backup and starts building the escape hatch in earnest. The Saudis didn't maintain the petrodollar for 50 years because it was mathematically optimal. They maintained it because the American military guarantee made the financial friction acceptable. The very second an American president says the security umbrella only covers America's direct interests, the commercial calculus shatters. The Carney MBS Summit, Al Falih's Bay Street Tour, and the January MOU are simply the institutional manifestations of that shattered calculus. The specific rails being used to build this new financial highway tell you everything about the speed of this shift. Look at the Enbridge platform, a blockchain powerhouse engineered by Saudi Arabia, China, the UAE, and Hong Kong since 2021 specifically to settle cross-border central bank digital currencies without ever touching a dollar-reliant correspondent bank. Saudi Arabia threw its weight behind it as a full member in 2024. It's while Canada hasn't officially jumped onto Enbridge, those intense November 2025 Bay Street meetings and the April Carney MBS call were fundamentally about establishing the financial settlement terms for this massive new commercial empire. Canada's January 2026 multilateral deal offers the exact template: secure massive bilateral trade flows using domestic currencies, entirely bypass the dollar for those specific exchanges, and simply leave the broader legacy dollar system spinning in the background. The fact that the dollar's share of global foreign exchange reserves bled out from 71% in 1999 down to 57% today represents a brutal 14-point plunge over 25 years. It is not a sudden, dramatic collapse. It is the quiet, compounding rot of a structural shift that never commands a massive headline, but steadily eats away at the edges until the edges have consumed half the foundation. Just look at the unassailable facts on the board. Saudi Arabia walked away from its petrodollar oath in June 2024. The Strait of Hormuz is operating toll booths in yuan. Canada and Saudi Arabia locked in a massive critical minerals pact in January 2026, and Carney and MBS are rapidly accelerating deep integration across energy, tech, and defense. Saudi investment architects are actively hunting on Bay Street and in Ottawa. Riyadh is dumping 4 times the crude into China that it sends to America. The West just fired up a $560 billion allied settlement network explicitly designed to freeze out the US dollar. Meanwhile, Brent crude is choking economies at over $100 a barrel, jet fuel is burning at $4.26, and a chaotic wave of illegal tariffs and Section 301 investigations are totally distorting free trade. Most importantly, Canada decisively refused to shackle its strategic future to American energy integration, opting instead to build its empire alongside a Saudi state that is aggressively abandoning the very dollar arrangement that defined it for a half century. Individually, these are not the death of the petrodollar. Together, they are the unstoppable compound interest of systemic transformation. They represent a newly organized world operating entirely around the dollar, rather than forcefully routed through it. Ask yourself, can the 52-year legacy of the petrodollar system realistically survive the simultaneous expiration of Saudi Arabia's foundational commitment, the rise of yuan-priced transit tolls in the Gulf, a $500 billion allied bypass mechanism, is a massive Canadian Saudi tech and energy alliance built outside American financial gravity, a 14-point plunge in global reserve dominance, and an American president publicly shouting that the world's most critical energy choke point isn't his problem. Henry Kissinger fully understood the catastrophic stakes of this question back in 1974, just as Mark Carney and Mohammed bin Salman understood them 11 days ago when they finalized plans for their energy, minerals, defense, and aerospace empire. It's the exact same question driving every single sentence of Deutsche Bank's panicked client note and riding on every barrel of oil paying a yuan toll in the strait. When the cornerstone deal that monopolized the world's greatest commodity quietly dies unrenewed, when 20% of the global oil flow pivots to a rival currency, and when the planet's resource titans deliberately construct trade networks designed to dodge the greenback, what exactly is left of Kissinger's grand 1974 bargain? Especially when the current US president considers protecting it someone else's problem. The petrodollar didn't just collapse this week. It suffered a fatal fracture 2 years ago when the Saudis walked away. It cracked further the moment Iran weaponized transit tolls with the yuan. It cracked again in January when Canada and Saudi Arabia sidestepped the dollar to build the clean energy supply chains of the future. And it shattered permanently on April 29th during an 11-minute phone call between two nations, solidifying a new strategic world order, while 52 years of petrodollar dominance quietly bled out in the background. We are watching the architects of the next century lay their foundation while Washington argues over the blueprints of the past. The real question isn't how long the dollar survives, but who will be left relying on it when the dust finally settles. $1 energy transactions. This isn't a theory. Real tanker captains carrying real cargo, actively filing documents with Iran's Persian Gulf Strait Authority and paying their fees in foreign currency just to get through. A single toll might seem insignificant. But compound that across the hundreds of massive tankers navigating the choke point and you realize this is the first time since 1974 that a central artery of global energy trade has been formally stripped of its dollar mandate. Deutsche Bank's Malak Safdeva was dead on when she labeled this conflict the primary catalyst for the death of the petrodollar and the rise of the petro-yuan. She was simply describing the cold reality of an Iranian bureaucracy siphoning yuan from desperate tankers moving oil to buyers desperate to escape American financial gravity. Do not underestimate how closely Saudi Arabia and the UAE are monitoring this situation. Yes, Riyadh backed the U.S.-Israeli strikes and opened up the King Fahd airbase to American jets. However, regional analysts speaking to Middle East Eye have bluntly confirmed that the war has deeply fractured faith in the United States as a reliable long-term security blanket. Saudi tactical support for the immediate offensive does absolutely nothing to cure those terminal doubts. It is merely a short-term band-aid while the kingdom aggressively engineers a parallel global architecture that will survive regardless of whether Washington decides to pack up and leave the region. That parallel architecture is exactly what we are witnessing with Canada. The deep integration sketched out in the Carney MBS call, the Al Fali visits, and the January MOU proves Riyadh is locking arms with a nation that doesn't threaten the Gulf, possesses the exact critical resources Vision 2030 demands, and is executing its own desperate pivot away from a single partner dependency. An RBC Trade Zone report from November 2025 tracked this relationship accelerating from complete radio silence just a few years prior to a full-blown exploration of massive strategic trade deals. It is built on pure, undeniable leverage. Canada has the raw materials the Saudis need, and the Saudis have the endless capital Canada's diversification strategy requires. Canada brings clean hydroelectric power, critical minerals, massive expanding LNG export capacity, bulletproof democratic stability, and Mark Carney's relentless drive to sever Canada's total reliance on American markets. Saudi Arabia brings the $700 billion war chest of its public investment fund, which is aggressively hunting for infrastructure assets. They possess the raw buying power to consume Canada's LNG, clean tech, processed minerals, and the advanced aerospace hardware vital to modernizing the Saudi military. On top of that, the geopolitical chaos of the Iran war has suddenly made Canada's Pacific LNG pipeline, routing gas safely through British Columbia straight to Asia, exponentially more valuable than at any point in history. If you read the official readouts and the Minerals Forum proceedings, you'll see these two nations are fusing together across 5 massive domains. They are locking down energy, specifically renewables, EVs, and nuclear. They are integrating advanced manufacturing, including drones and satellites. They are merging AI and quantum computing sectors, monopolizing mining and critical minerals, and sharing advanced education and healthcare frameworks. This is not the behavior of a country merely buying a few boatloads of commodities. This is the deliberate construction of an entirely new economic ecosystem. Historically, this scale of trade was tethered exclusively to the dollar-denominated oil market. Now, they are organizing it around clean tech, AI, and minerals, utilizing emerging financial settlement mechanisms that deliberately bypass American financial oversight. We already saw the blueprint for this financial bypass early this year when Washington wasn't looking. In January, a $560 billion multilateral settlement agreement was quietly inked by Canada, Germany, Japan, South Korea, Australia, and the UK. This framework was explicitly engineered to allow over $500 billion in allied trade to clear seamlessly without ever touching the US dollar. This mechanism doesn't instantly evaporate dollar dominance. What it does is definitively prove that top-tier allied democracies possess both the technical and legal capabilities to process massive volumes of global trade outside the American banking system. They aren't leaving this escape hatch strictly to adversaries like Russia, China, or Iran. It is a highly rational defensive countermeasure against Washington's obsessive weaponization of dollar access via endless sanctions and tariff wars. Canada's embrace of Saudi Arabia is happening exactly within this shifting paradigm. The massive $700 billion Saudi Public Investment Fund has realized it no longer needs to run every single transaction through a middleman in New York. Read the fine print. That massive January 2026 critical minerals MOU has absolutely zero clauses mandating that the trade be settled in dollars. When Khalid Al-Fali was sitting down with Canadian capital markets on Bay Street, they were actively designing a financial highway to serve their mutual interests. Interests that are no longer tied to American financial intermediation. Let me pause here. I am not peddling sensationalist de-dollarization collapse theories. The US dollar is not going to vanish overnight. As Paul Bluestein from the Center for Strategic and International Studies correctly observed, even a severely crippled petrodollar doesn't negate the immense depth, liquidity, and breadth of American capital markets that no other currency can currently rival. The CFR's Brad Setzer also pointed out in April 2026 that while the absolute glory days of the petrodollar are finished, global dollar liquidity is sustained far more by Asian manufacturing surpluses today than by Gulf oil states hoarding offshore cash. These are rigorous analysts outlining a financial system that is incredibly tough and resilient. But they are missing the core point. The question is not whether the dollar will die entirely. The question is whether it will retain the unique, inescapable indispensability that 52 years of petrodollar hegemony artificially granted it. The true superpower of the petrodollar was never just the sheer volume of cash moving for crude. Its real power was the massive artificial demand for dollars it injected into every single layer of the global supply chain. Andrés Arauz, the former head of Ecuador's central bank, broke this down perfectly for green central banking. Yes, oil and gas are traded in dollars, but consequently, every single downstream derivative is traded in dollars. The entire petrochemical industry and every chemical element pulled from crude relies on the dollar. Move upstream, and the massive machinery and technology required to drill the wells are also priced in dollars. This created an inescapable, globalized dollar-denominated value chain. The petrodollar was not a single trade. It was the gravitational organizing principle that cascaded through the global economy and generated relentless dollar demand at every conceivable stage of production. What Canada and Saudi Arabia are aggressively doing right now is building an alternative organizing principle for a massive segment of that exact value chain. Imagine Canadian critical minerals, excavated using Canadian clean hydropower, sold directly to Saudi and Asian markets through non-dollar bilateral currency frameworks, and completely fueled by Pacific Coast LNG sold at premium world prices rather than at the brutal, landlocked discount US refiners forced on Alberta for decades. That is a fully functioning, self-contained segment of global trade that structurally does not require a single US dollar to operate. While it's not the entire petrodollar system, it is the undeniable genesis of an alternative architecture, launching at the exact moment the Iran war proved to every energy producer on the planet that the American military guarantees underpinning the dollar were dangerously conditional. Look at what President Trump publicly broadcasted to the world during this very conflict. It's a quote caught by Middle East Eye, and I promise you every single Gulf official has it framed in their minds. He explicitly stated that the United States does not use the Strait of Hormuz. We don't need it, he declared, pushing the burden entirely onto Europe, Korea, Japan, and China, casually suggesting they need to get involved a little bit. As a political observer, I can tell you that sentence is the single most catastrophic and consequential statement any American president has made regarding the petrodollar since Nixon shattered the gold standard in 1971. He wasn't just abandoning a shipping lane. He completely reframed America's bedrock security commitment as a transaction that only applies if Washington directly profits from it on any given day. The entire 1974 Kissinger Pact, the core reason the Saudis swallowed the inconvenience of dollar pricing, was completely anchored on America's absolute willingness to keep the Gulf navigable. When the US president stands at a podium and declares that navigation is somebody else's problem, the Saudis hear it. The Gulf Cooperation Council hears it. And every nation that has spent the last 5 years quietly prototyping alternative financial plumbing hears it as the ultimate green light to pour the concrete. Warren Buffett nailed this behavioral dynamic perfectly. He noted that in any long-term commercial relationship, the absolute loudest warning siren is when one party publicly and arrogantly demonstrates that they view their loyalty as conditional on their own